In the coming 1 hour, I will present the result of our global private banking survey we did globally on a 2-year basis. What happened is, on a 2-year basis, we, PwC Global Network, Private Banking Network, will interview the private banks from the CEO, CRO, relationship manager, back to back office, operations, risk management, and then have a very comprehensive interview with them to identify the challenges, opportunities they face in the private banking industry. So this is our most comprehensive global survey up to date. And we did this survey back to early 2011, last year. And we actually, this year, are quite successful. We have 275 organizations across 67 countries participate in this survey. And you can see that in the slides. When we look at the Asia Pacific contribution, this year we got 30% of our participants are from Asia Pacific. That's why, because Asia Pacific we got a 30%, so that's why we can have an Asia cut. Because in the past, if the participant from Asia is not so much, then we don't really have an Asia cut, and then it becomes less relevant to us here. So this year we do have an Asia cut. And there's 43 participants across 8 countries in Asia contribute to this survey. And Hong Kong, Singapore, not surprisingly, comprising near 50% of the respondents. So we have the report available in our website, the full report of the survey results. But I think here I will just highlight a few observations, interesting observations and trends for your information. And hopefully we can have a more interactive discussion later on. Okay. One question we asked the participant is, what do they think about the top 5 international financial centers nowadays? And what do they think about after 2 years? What are them and the ranking? I think the factors they consider probably is the AUM, the opportunities, the development, regulatory environment, all these factors take into account. And you can see that there's a trend that today people still see Switzerland, London as the top international financial center in terms of private wealth management. And Singapore, Hong Kong is ranking number 3 and 4. But in 2 years' time, the participants think that Singapore will increase the ranking to number 1. And Hong Kong also increased the ranking ahead of London. I think this is a very encouraging result, and one of the reasons probably is everyone knows that the wealth actually emerging very quickly in Asia. So, and many people, many private banks, even in Switzerland, London, thinking about moving some of their assets to some of their clients to Asia, because there's more investment opportunity in Asia. And I think nowadays, Hong Kong government also have this initiative to promote Hong Kong as a private banking center as well. And in conjunction with government's effort and the industry effort, hopefully we can be ahead of Switzerland or Singapore in the next 2 years as well. Yeah. So one of the observations, we categorize our results of the survey into several aspects. You can look at this aspect. We look at it from performance perspective. Performance means the private bank's financial performance. And then we analyze some information in terms of their markets and client segment. The third one is their client relationship management and human capital. That means talent management. And fourthly is the risk management and regulations. And last but not least is IT and operations. So in terms of the performance, at this chart, you look at it, actually, X-axis is the cost to income ratio. If we use 60% as a cutoff, and you can see that there's most of our respondents, that means, look at the right-hand side, about 72% of our respondents saying that their cost to income ratio is higher than 60%. So 60% is quite high, to be honest. If you look at some sort of local retail banks, cost to income ratio is talking about 40, 50. And 60% is quite high. And then when you look at the revenue growth on the sort of the cutoff 10% revenue growth, you can see that only 9% of our participants saying that they can achieve more than 10% revenue growth, but at the same time can manage the business, manage the cost to income ratio lower than 60%. So only 9% of our respondents think that they are quite profitable and efficient, right? And in Asia, this is a global result. Asia respondents mostly fall in 21% category. That means we're facing a high cost to income ratio, but our revenue growth rate can be more than 10%, no surprisingly, right? And so I think what we are facing in Asia is the cost to income ratio is really high. So this is the numbers we extract from our survey result back to 2009, 2010, and forecast 2011. And you can see that when we compare Singapore, Hong Kong result compared with Switzerland, our cost to income ratio actually a lot higher than Switzerland. In 2010 and 2009, it can higher than 90%. Probably at that time, there's many compensation need to pay out to some sort of complaint cases. There's you remember the financial crisis, there are lots of complaints about mis-selling those things. That may be part of the reason why 2010, it can be as high as 97%. But forecast 2011, because this survey we did in early last year, that's why still have a forecast 2011, is still above 80%. Probably nowadays it's a much worse because at that time people still forecast the revenue growth is still quite good. But last year, especially in Hong Kong, this fourth quarter, I think everyone knows that it's a very difficult environment. The revenue growth is also a challenge for them. So I think the key issue facing by the private bank here is the cost, definitely, because the cost main component is the salary, staff costs, and also the regulatory environment become more strict, so that the regulatory cost also very high. Okay. So this is the performance highlights. And then when we look at the markets, we look at the client segmentations. So when we ask about what factors or what parameters the banks use to segment their clients, and of course the current asset, that means AUM, definitely is one of the key criteria to do the segment of your client base. And then there's more about ultra high net worth. Some banks actually carve out the ultra high net worth as a separate segment because they think that the service model, the business model is different in terms of serving ultra high net worth and high net worth. And then there's others, client risk profile, for example, and last one, you can see that passive and active investment style. Those are also some factors which some banks actually use to segment their client portfolio. So ultra high net worth, I want to spend some time talk about this particular segment because I know that many private banks actually carve out this for special sort of service model to deliver that. But one observation is for the ultra high net worth, the existing sort of the issue they are encountering is the intergeneration wealth transfer. So when I talk to one big private banks in Hong Kong, they are saying, okay, their ultra high net worth client average age is more than 70. So more than 70, the existing client base. So it's a huge problem for them in terms of intergenerations wealth transfer. How, as a private bank, ensure that when they do the intergeneration wealth transfer, they can still keep the wealth into the private banks as AUM, right? So this graph is a little bit difficult to read, so maybe I explain in more detail. So one question we ask the private bank is, if there's an intergeneration wealth transfer, then how much they will expect they can retain the wealth in that particular private bank. And then you can see that in the XSS, if the wealth transfer to the surviving spouse, that means then the wealth, actually 57% of the respondent, the pink color, saying that they will expect they can still retain 51 to 75% of the wealth. It's quite good, right? So if you pass your wealth to your wife normally will still use the same banker. Put it simply. But when you look at the children, if your client transfer the wealth to their children, then you can see that only 21% of the respondents saying that they are confident that they can retain 51 to 75%. That means the rest actually think that, they will expect the wealth they can't retain, the wealth they can retain is less than 50%, right? So I think the issue is on the children. So normally, if you transfer your wealth to the children probably have their own friends, their network, their own preferred bankers. They probably will transfer some wealth to other bankers to use that. So I think the challenge for the private banks now is we are facing the aging of the existing client portfolio. If that's the case, what should they do to ensure the RM actually linked to the next generations? And some banks, when we talk about these topics with different banks, and I think some banks will organize some events and for the next generation, the second generations, and then introduce their private bankers to those next generation. Some banks have the strategies to focus about the family matters, family business. It's not a family office type. It's just when you have a relationship with the clients, they will just focus more about what is your family matters, what are the issues facing by your family business, can I help you to do some sort of negotiations or liaison role within the family. So those are sort of value-added service. There's not a fee, not a revenue-generating activities, but there's value-added services, and through those processes, they probably can establish a relationship between the private bankers and the second generations. So we asked the questions about how about the challenge facing the private banks about the business growth prospects. And you can see that there's a lot of challenge. The first one definitely is talent, But attracting the next generation of client actually still ranking quite low when we ask the CEO about these questions. But I think they should be aware of that, and some banks already taking actions. And in order to maintain the competitiveness, I think some measures need to think about. Yeah. So another feature of the ultra high net worth is the family office services. Normally, for a particular family, they will establish a family office service to provide different services to that particular family. And some banks also enter into this market. And when we talk about this, about what type of service those private banks plan to put in the family office, there's a sort of all the services they want to put in. And the top one definitely is the asset allocation, trust planning. Those are very normal. But what we want you to focus is how about the family education. There's a softer aspect like cash management or other property management. Those area is also the opportunities you can provide to your clients in the family office service. And normally, 2/3 of these services, the private bank actually work with third-party providers like lawyers, like the accountants firm like PwC. so that's why we work with the private bank quite a lot when we talk about, for example, suddenly the family business want to do the IPO. They definitely need lawyers, they need accountants, and then we work with the private banks quite a lot on that.